I've got the numbers. I want to start going through these, and then Charles is going to anchor the program. But so 216,000 is the actual number. This is the headline number for non-farm jobs. 216,000. Wow. So it is much stronger than expected. And the estimate was 170,000. Taking a look at the market, we are seeing a real escalation, guys, of selling. I got to point that out. Now, the unemployment rate did not tick up as expected. It came in at 3.7%. We were looking for 3.8%. But again, that non-farm number coming in much stronger than expected. Going down to average hourly earnings, year over year, that wage inflation story I was talking about, it jumped 4.1%, and that was higher than expected. And then also month to month, that wage inflation, average hourly earnings jumping 0.4%. That's higher than expected. The average was 0.3. Labor force participation rate, that came in at 62.5 labor force participation rate. The U6 number coming in at 7.1%. And then again, going down to some of these other jobs. I want to hit that government jobs number, guys. 52,000 on the government jobs. That is high. That is very high. Look at that, Charles. That's wild.
Yeah, the market has not changed a lot since this number came out. Yeah, we're a little bit redder, but not much redder. And those two things you just mentioned jump out big time. Labor force. The labor force went down. What the hell is going on? That's why participation, this is a big move down. 62.5 from 62.8. That is absolutely huge. We went from 168 million workers to 167 million workers. That's a monster decline. Of course, you back out these 52,000, and what do you have here? You have 155, right? So that misses the number. This is what we're really talking about. The private sector is struggling, and you know maybe they made up for it with wages. But one thing that we got to look at too, Cheryl, because it's not just wages; it's work week. If employers want to hold on to workers, and of course we know they're loath to lay them off and retrain new ones, they have been shortening the work week. That's been the secret sauce. That's been the thing that's hurt people. So it's awkward when they say, well, wages are now above inflation. Yeah, but pay isn't if I'm working fewer hours.
Average work week, Charles, came in line at 34.4. But again, I keep going back to that government job. That's exactly what I was talking about. Anyway, Steve Moore, jump in here. Your initial reaction to these numbers.
As I was just saying, the fastest growing sector of the economy over the last year has been, well, a combination of healthcare and government. And then you have university jobs, too. You throw in that. And those are also associated with government. I think we've had now for the last year or two the government kind of carrying the economy on its shoulders. That cannot persist. I am happy to see that you're seeing slight wage gains. But come on. I mean, somebody's got to explain to me why people are leaving the workforce. I mean, we should be in a recovery. We should be seeing people joining the workforce. Yeah. That is bad news for the American economy.
Rebecca, I'm going to Charles, go ahead. But I bet you it's
just let me share some other things with the audience because these are red flags. Transportation and warehouse down 22,000. The reason that was amazing is for a while people were able to leave leisure and hospitality jobs, low-paying jobs, and get a job at a local warehouse. These Amazon warehouses made a lot more money, a lot more benefits. This number is now negative 3 months in a row. Also, temp work. Temp work has been negative every single month. Typically, that's an indicator where the workforce is. They're laying off temp workers, and they're not becoming permanent hires. So, two additional red flags.
Rebecca, what are you seeing?
Me? Okay.
Yeah.
Well, I mean, I think someone's going to be $10 million richer because the yields are going to go up. So that person made a good bet. I don't know if it was inside information or not. But, you know, this is going to put more pressure on Powell, right? Because now he is kind of backed himself into a corner. We've got 3 rate hikes coming. The market won 6. And yet the jobs data is still showing that, you know, it's showing that things are coming down, that we are going to expect it to come down. But it's just the market getting ahead of its skis again, and then you're going to have yields go up, and that's going to be problematic.
That's interesting. Lewis, what do you make of this?
Well, first of all, it's a Friday, and traders like to clean out their inventory on Fridays because, you know, we have things like attacks in the Red Sea and stuff going on. So yeah, we're going to have a rough opening, but earnings will be coming out. Earnings are going to be good for the next 3 quarters, easy year-over-year comparisons. So probably every stock for itself. And I have not seen analyst cuts yet. I've seen some analyst downgrades, but no cuts. So I think we'll be rescued by earnings in a couple weeks, and then hopefully bond yields will settle back down, because obviously they're up today, and that puts us in a bad mood.